Hey, everybody, and welcome back to our monthly market commentary. My name is Brad Gatto, founder and CEO of Fiat Wealth Management. I've got Tim Holland here with me. Tim Holland is the CIO of Orion Town Square, and he's kind enough to join us every single month for this update, our monthly market commentary. Tim, thanks for being here, man.
Yeah, good to see you, Brad.
Before we get into the meat and potatoes, our three main points of this last month, just how are you? What's new?
So I'm doing okay. It's gotten cold here in PA. I assume you've already blown through your 2 weeks of fall in
Yeah.
the upper Midwest. Again, you folks are a lot tougher than I am. My son Spencer, his middle school football team's undefeated. He's turned into a decent linebacker, so that's been cool. And I think I already told you this maybe, but our daughter plays lacrosse and she committed to play at Boston College. So
That's
she's
awesome.
super psyched. And we had a pretty good Halloween. I mean, my kids don't trick or treat anymore, but we had some trick or treaters. The one funny thing about I think our kids and trick or treating. So I asked my 14-year-old son, or he's about to be
Yep.
14. Spencer, you guys going trick or treating? Are you going out tonight? And he's like, no. And then there's this pause. He goes, not really. I'm like, wait, hold on. Now, what exactly does that mean? So anyway, but we're good. How have you guys
Uh,
been? How have you
we're
guys been?
good.
Good.
It was a different Halloween for us because it was the first year that mom and dad weren't toting around with the kids. We had
Oh
my oldest son,
wow.
who was your Spencer's age, did not
Yeah.
trick or treat, stayed with buddies, hung out, and the younger one
Yep.
took off with his buddies, and we were a
Yeah.
distant memory on his never ending quest, Halloween, aside to get candy. So,
Yeah.
um, and he was highly successful.
Good for him.
So thanks for asking.
Yeah.
Before we get to the three main points, I'm gonna put you on the spot, ask you one question that is burning in
Yeah.
my brain that may also be burning in some of the viewers. Behind you, you've got all kinds of books,
Yeah.
most of which are in, and we can see the spine of the book. You got a couple forward-facing books.
Yeah.
One is kind of the red with the
Yeah.
dot, the black dot there. What is
Yeah.
that?
So that's The Laws of Human Nature by Robert Greene. So he's
Okay.
written The Laws of Power, New York Times bestselling author, big in strategic thinking, and people and relationships and power dynamics for sure. So it's a pretty interesting book, in that it's helped me understand me and all of us
Yeah.
a lot better, right? And whatever you learn in school is super important, but if you can figure out human relations, which took me a long time and I'm still working on it, you're going to be okay in life. And it's a neat book. It's like
Yeah.
it's taken a while, but it's all based on sort of historical, real life folks, what they went through, the Napoleons of the world, the Marie Antoinettes, and Henry VIII, and sort of what they did right, what they did wrong. And again,
Yeah.
it's about sort
Interesting.
of power and understanding people and relationships, and it's been really helpful, I think.
I had no idea that's what that book was. This is not planned, but I will tell you, I love the fact that you've read it because at the end of the day, the markets are not primarily driven by data and
No,
fundamentals.
yeah,
They regress to that mean over time, but the
yeah,
day to day of the markets and what you and I are talking about month over month are actually primarily, I would argue, driven by human behavior.
yeah. And I agree 100%. He's got another book, so he's written a bunch of books. So the laws of human nature, 48 laws of power, and a few others. But he's got a daily compilation, which you can kind of see on the upper right, maybe called the Daily Laws. So it's a 1 page or a page and a half per day, and he just pulls from all his different writings, and it's a little bit on human nature, a little bit on strategy, a little bit on power, and depending on the month, it's a different theme. And so that's something I just flip through on a daily basis, and that's a neat kind of compilation of some of his
Love
best
it.
thinking. So
I'll
yeah,
look for my
that's
copy in the mail.
all right. You got it. You got it. It's on its way.
All right.
Thanks to
Three
Jeff
main
Bezos.
points. It's
Yes.
uh it's November now. So we're gonna have three main points for November, looking back at the month that was and the month that is going to be. And so point number one, we decided to dub It's Always Darkest Before the Dawn. And the reason that we dubbed it that is because, quite frankly, these last couple of weeks have been kind of a whipsaw. And so last week, as of last week, correct me if I'm wrong here, we technically entered a correction. Now,
Yep.
if you're unfamiliar, there's different words: recessions, corrections, and other ones. Tim, that you could probably fill us on. A correction by definition is 10%.
Yep. Correct.
Right? We've come back down 10%. So not awesome, not ideal in a couple month time frame to hit a 10% correction. So that was bad news.
Yep.
But then this last week, everything changed. talk to us about these last couple of weeks and what's been going on.
Yeah, sure. And it's interesting that we did enter a 10% pullback on the S&P 500, which is the index I think most of us pay the most attention to. And then we just closed the books today on the best week for the S&P this year. So I think the first lesson, and we've talked a lot about this.
So as we record this, it's Friday.
Oh, yeah. Sorry.
That as of market close, which is closed, it's 4:30 my time, 5:30 your time. So thanks for sticking with us late on a Friday.
Sure.
Market's closed, best week of the year.
Yeah, best week of the year following on the week when we went into a correction. So, Brad and I were talking about this earlier, and I know this may sound a little trite, but trying to time the market, tricky proposition, always darkest before the dawn. So you could argue Friday was the darkest point, at least since maybe the banking crisis in March this year. And a lot of folks were like, probably get me out. I can't take this. Bad August, September, October. And then in 5 days, the S&P is up 6%, and you have the best week for 2023. So just, I think, a really powerful reminder not to try and time the market, which I know you and I would never try and do. In terms of what has happened, at least over the last couple, 3 months, and I'll try and condense this, August and September and October were all down. Bond yields kept moving up as inflation pressures were feared to be maybe more than expected going into the end of the summer and early fall. Oil prices spiked for a little bit on the awful events in Israel, the awful attack by Hamas. And so as yields went up, that pressures stock prices. The geopolitical dynamic was very unsettling for sure. It still is. And then what's happened, I think, in the last 5 days, and I may end up speaking to point 2 and 3, and I don't mean to jam them all together.
Don't ruin point 2 and 3. We have 3
I may ruin point. I'm still practicing these three points, so Brad's going to get mad at me. What happened this week was the Federal Reserve met, and they didn't raise interest rates, which we didn't expect them to. But they acknowledged the fact that the move higher in bond yields did a lot of their work for them, right? Bond yields go up either because the Fed's raising rates and the market's responding, or the market's just selling off bonds and rates are going up and yields are going up. So that means borrowing costs are going up. So Chairman Powell acknowledged that the market had tightened financial conditions. And then to fast forward to today, you got a jobs number for last month that was disappointing. So I think after 10, 12 weeks of we're worried about inflation, we're worried the Fed's not done, in a very short period of time, the narrative switched to, wait a minute, the jobs market may finally be weakening. Chairman Powell acknowledged that the market's done a lot of its work for it, that being the Fed, and maybe we are done, and maybe the market's going to start to catch a bid because interest rates will be lower sooner than people think. And even if the economy weakens, and we talked about this on the last call, maybe the market will be okay from here. So again, we'll see, but I think at a high level, that's kind of what happened this week and over the last couple of 3 months. And I hope that wasn't too much.
I mean, it was very nerdy. But at the end of the day, what we should all take from this is, so you're like, these last couple of weeks, the sentiment couldn't have swung more, right? And I want to acknowledge the fact that this year, I feel like more than any year that I've been in this business, we walked into the year with more negative sentiment from the average consumer than I can remember. And that may just be a short-term memory thing, but like, I think everybody kind of expected a recession coming into this year, and we're all just kind of sitting on pins and needles and waiting for it. And so hitting that point of correction was like this self-fulfilling prophecy of like, see, I told you, like I knew it was coming. We probably should have done something different, all these sorts of things. And then, I mean, couldn't have been faster. It's the end of last week, the beginning of this week, one market day to the next, we start this little climb back and we have the best week of the year. Now, you and I don't know if that's going to hold or if we're going to go right back into the correction period next week. But at the end of the day, it just goes to the sentiment of trying to time the market is impossible.
Yeah. And since I hijacked, sorry, go ahead. And since I hijacked your second and third point, I'll throw in another point. So you just talked about sentiment. And so there are different gauges that we follow, right? Fiat does and Town Square does as well, Orion does. And one is the American Association of Individual Investors Sentiment Survey, AAII. They've been doing it for decades. It's on their website if you want to go look at it. And if you go back to early August, right after the S&P had that great run through July, was up almost 20% year to date.
Mm-hmm.
The folks in that survey at that time that were bearish or cautious on the market was about 22% out of the 100%, full pie.
Yeah.
Typically, the historic average bearish reading is 32%. So it's 10 points below, meaning people were much more optimistic than pessimistic, which made sense because the market had done really well. If you fast forward to the end of October, the bearish sentiment had swung from 22 to 43%, well above the historic reading as well. And again, sentiment is a classic contrarian indicator. Sort of going back, I know you guys are upper Midwest, but back to the great Midwest, Warren Buffett has famously said, be greedy when others are fearful and fearful when others are greedy. So to Brad's point, sentiment had swung so far, and we'll see if it sticks, that the market was due to bounce. We got it this week. We'll see if it continues, but sentiment's a classic contrarian indicator. People are optimistic, be a little cautious short term. People are super cautious, be optimistic. So
yeah, it's worth acknowledging, Tim. It's tough to run into a fire. I don't care who you are.
Man, so hard.
And even if you know all the facts are that I'm going to make it out of that fire on the other side, it's still tough to do. It's the same thing as like standing in front of a cliff, you know, and you got the bungee cord on, and the odds are in your favor that this thing's going to work out and I'm going to be just fine. But convince yourself to jump, right?
Yeah, oh, for sure. Yeah, and I did bungee jump once a long time ago in New Zealand, in Queenstown, where I think they invented it. And I'm out on the little platform, and I got the things around my ankles, and I'm like, okay, I guess I got to go now, right? And the guy running the thing couldn't have cared less about me. He just stared at me he's like, I got to do this all day listening to you tourists. He's about to just shove me off that thing. So
I'm surprised that's not where that story was going. I thought that's what you were going to say, is he just pushed you. So you did take my point number 2, by the way. Point number 1 was darkest before the dawn. Point number 2 is the Fed met again.
Yeah.
And they did what we expected them to do, which they didn't raise rates even further. But what you mentioned was, and it's a point worth repeating, what came out of that wasn't just what was expected. It was that they kind of admitted the fact that what happened with bond yields, 10-year Treasury had peaked over 5%, which is important because that's government debt, right? That's a really good barometer of where fixed income non-risk assets are. Hadn't been that high in over 16 years. And that puts a lot of other pressures on. So without getting into all like the details of like the other pressures that puts on the economy, that was a big deal. So they had basically admitted that, hey, look, we were doing our job to try to slow things down, but without our help of raising rates even further, the bond market kind of did some work for us.
Yeah, I think that's a great way to think about it. The Fed met in September. They didn't raise rates then, but they came out in a very sort of hawkish posture, which is we're going to keep rates high, and the whole narrative around higher for longer started to gain credence. And over the next 6 weeks, the market's like, okay, if we're going to be higher for longer, let's go. And so the 10-year yield broke 5%, as you mentioned, Brad, and a lot of interest rates are based on that. So borrowing costs went up, and then Jay Powell, to his credit, came out this week and said, as Brad just mentioned, we didn't raise rates in September, we didn't raise rates this week, but we acknowledge the fact that costs have gone up for companies and consumers because of what the bond market's done. So the bond market's done a lot of our work. And acknowledging that kind of shifted the tone away from that higher for longer to, financial conditions, as they call them, have gotten tighter, which means money's gotten more expensive, which slows the economy and hopefully helps the Fed deal with inflation.
Yeah. Well, I just hope I get to a point someday where I am as important of a person as you are, because I call him Mr. Powell. I didn't know that you were on such tight terms with him that he's Jay Powell for you.
Well, they all work for us, right? I think.
Yeah, right. They all work for us. I think that's been over since money entered Congress. But that's a whole different conversation, different day, because we have one more point I want to get to before we let everybody go. And that is last month, you had a sentiment of what was going to happen in October when we recorded this video a month ago.
Yeah.
I hate to do this to you, but you were wrong.
Yeah, aren't we out of time?
You said that October was going to be a better month, and it wasn't.
Yeah, no. Aren't we out of time? Isn't there? Do you have the full?
That's what you were doing with point number 1. Is you're trying to just get it all in, run me out of time.
I didn't know you had the full Zoom subscription. I was hoping you had the whole 10-minute. No, all seriousness, all kidding aside. No, it was great to be with you all in person in the great state of Minnesota. And when we went into October, October is typically a pretty strong month for the market. September's typically the worst month for the market. So we had the calendar in our favor. I thought bond yields, which were already in the high fours, were done, right? I thought, we were going to sort of exhaust that move higher, and that, we would start to kind of look to the other side of the mountain in terms of inflation. And we had a CPI, consumer price index, print for September, and a producer price index for September that both came in a little bit hotter from an inflation perspective than people thought. And so you put all that together, I was wrong. The markets were off about 2%. To your point, the bond sold off as a 10-year hit, 5.02% the yield. So fast forward, again, 1 week doesn't a trend make. November, which I may have mentioned earlier, is the strongest month for the S&P 500 going back over 70 years. Sentiment, because I do think a lot of folks like me were thinking, okay, we're through August and September, and October hit people really hard, I think, because we got off to a good start the first couple of days, and then you had, again, the awful events in the Middle East. And so sentiment's been reset. You are in the strongest month of the year. Earnings have come in okay. And again, I think the Fed acknowledging the tightening in financial conditions is and was a big deal. Yeah. And the 10-year yield has gone from 5.02 to 4.5. So it's only down 0.5%, but it's down 0.5% in a very short period of time. And you've got a weaker than expected jobs report today. So what we thought would happen is the economy would slow. We'd get maybe a mild recession, not a terrible recession. Main Street would struggle into 2024, but the markets would do okay. We were wrong in October. Given some of the data this week, we're a little more optimistic, not that we're rooting for anyone to lose their job, but we're a little more optimistic that we're kind of at that inflection point. But I was definitely wrong, for sure.
So the point is to defend you.
I'll take it.
What you're saying is the sentiment or the thought process wasn't necessarily wrong yet. It may just be you were a little early. And then early coming to fruition here in November. And I hope
that's what we're thinking. And what would change our mind would be a really hot inflation print. The Fed will meet in December. They'll get a couple more CPI and PPI prints, or a really hot jobs report. They'll get one more before they meet in December. This one wasn't hot. This one was weak. Yeah. So the one thing that would really get me to move off this position would be, a spike in inflation that just catches everyone by surprise and pulls the Fed back in. And based on the data we've seen this week, I'd be shocked if we got that. But that would be a big change for us. But I don't think we're going to get it.
Lovely. Really good stuff. So 2 takeaways that I got out of this, that I hope all of you got out of this. And this is redundant. It's redundant on purpose because, again, it's hard to run near the fire. Timing the markets is a fool's game. In fact, you made a comment about Warren Buffett talking about trying to time the market. Interestingly enough, when I got into this industry 18 years ago, I still remember studying for my Series 7 exam to be able to operate in this industry and get my license. I had to study a theory called the odd lot theory. The odd lot theory literally states, Tim, if you remember from those exams years ago, watch what the average lay investor does, do the exact opposite, and you will make money.
Yep.
Which is crazy. But it's because the primary reason we make decisions is our emotions, then we justify them logically after the fact, and emotions drive these whipsaws in the market. Interestingly enough, and Town Square put this data out not that long ago. I'll say it in concept because I don't remember the exact details, but in concept, something like over the last 50 or 60 years, the S&P has averaged 10%. But in that same time frame, it's only hit the average like once or twice.
Yeah.
It's always way below it or way above it. And that's this short-term range of emotion driving results, and then the long-term fundamentals playing out. And so we're an extreme inflection point with that right now. So don't try and time the market. I'll say it again. Point number 2 that I take away from this is, with all this movement of interest rates that we've had, which is driving some of the decisions that the Fed's got going on, highest rates that we've seen in the 10-year Treasury in 16 years. I love it. And when you look at the yield curve, it can kind of lead you into this and lull you into this sense of like, stay short term, stay short term, stay short term, because I can get all this yield. But then you have all this reinvestment risk later on, and you may not be able to lock some of this stuff in. And so I do think it's worth the average, and we're having these conversations at Fiat. But if you're not currently working with Fiat or haven't had this conversation with your advisor yet, the idea of reinvestment risk and getting longer on the yield curve with some of your interest-bearing debt type instruments is worth it, because we would all love to go back to the early 1980s and buy a 30-year government bond. because then it felt terrible to get 13% when you're paying 18% on a mortgage. With hindsight being the benefit, we'd be like, every one of us would take that. Principally guaranteed 13%, locked in for 30 years. It's not that extreme right now, but there's a lot of meat on the bone when it comes to risk-free rates right now, and it's worth locking some of that stuff in. So with that being said, Tim, always wonderful to have you. Thanks for joining us for our November market update. We will see you early December. Until then,
see you in December, Brett. Thank you very much.
See you, Tim.
Bye.